And joining me now for a closer look on what's playing itself out in that market scene is Seleho Tsatsi from Anchor Capital. Seleho, always a pleasure. Good afternoon to you.
Pleasure to be here. Thank you.
Fantastic. Let's get right into it. An upbeat day on the JSE today, an upbeat day in Europe. This is obviously a complete opposite of what we saw at close of business yesterday. What is driving these sentiments this afternoon?
Yes, so I think what we're seeing at the market at the moment, or probably the biggest thing that's anticipated from the market at the moment, is the US CPI number that we should get today, I think this afternoon, South African time. And to the extent to which US CPI comes in either in line with or below expectations, I think it's likely we'll see the market react positively in the sense that it gives the Fed more leeway to start cutting rates or to fall in line with the market's trajectory for interest rate cuts. And obviously the converse to that is also true. So I think it's, in terms of sentiment, it's quite a big driver for what we'll see in the short term at least.
I must ask you, Seleho, what weighs more at this point, this data coming out or absolute conviction coming out of the US Fed about not being in a rush for rate cuts?
Yeah, so I think when Jerome Powell had his testimony last week, one of the phrases that was used was, it was one of the ideas he got across was that confidence is building that they'll be able to start cutting rates later this year. So they've still said that they want to have more confidence in or see more data that aligns with the idea of inflation coming towards and below 2%. But to the extent that we get another data point showing that inflation is moderating, I think that will be another important step along the way that will allow them to start cutting rates.
Another interesting one we are seeing is some strength from the rand. I'm wondering if this is rand strength or dollar weakness. Of course, we welcome it, Seleho, even though I think we've concluded that the rand is deeply undervalued.
Yeah, so I think whenever we look at the rand, we need to keep in mind that the rand doesn't trade in a vacuum. So it's always instructive and helpful to look at other emerging market currencies. And I think what we see when we do that is that this is largely emerging market currency strength rather than just the rand being strong on its own.
And then bringing it back home, let's take a look at what's happening on the JSE. Green screens all around, Naspers and Process upbeat, platinum miners also upbeat. Seleho, what's driving those sentiments? Is it that inflation story?
In the case of Naspers and Process, it's most likely the share price action that we've seen from Tencent. So over the past 2 days, that's had a bit of a recovery from pretty low levels. It's gotten close to its 52-week lows. Obviously, Tencent continues to be the majority of both profits and NAV for Naspers and Process. So that's really, I think, what's driving those prices. In the case of PGMs, we have seen, particularly for palladium, stronger PGM prices. Palladium, as we know, has, in addition to rhodium, has really been under pressure over the past 12 to 18 months for a variety of reasons. If you look at what the actual PGM miners themselves have said, they're quite cautious on, for example, palladium demand over the next 12 to 24 months. So we saw over the past week or two, we saw in their results that they were saying, for example, palladium demand due to ICE or internal combustion engine vehicle demand is likely to come down. So because ICE demand is likely to come down, that'll feed through into palladium demand. And so it's quite a tricky situation, I think, for those miners in terms of actual profitability, if you look at where the basket price is. Having said that, on Thursday, in response to Jerome Powell's testimony, palladium was up about 11% in US dollar terms as a result of short coverage. So there's really a lot going on in that space for sure.
I want to get into some company news now, maybe starting off with a home choice, which of course has a very deep roots in our households as young people, but now is a fintech business that seems to be doing super well, Seleho. Let's talk about that. You know, revenues are up, but also headline earnings up just over 7%.
Yes, it's interesting because when you hear of home choice, I think the average person probably doesn't think fintech business, or 90% of home choice coming from that segment. But I think the business has changed quite a bit from, as you said, where it was maybe 20 years ago. What's interesting, if you just broaden out and think about SA retail as a whole, the SA retail space has been under pressure, as we know, given the difficult economic environments that we've had locally. We've had sluggish GDP growth, very sluggish consumer disposable income growth for consumers. And so that's led to pretty tough operating environments for local retailers. And I think you've seen it if you've looked at the results and trading updates that we've had from the sector, things like, for example, Woolies or Woolworths recently. So it's interesting to see a company that from that sector historically kind of bucked that trend.
Very interesting, a company indeed, and I hope we can unpack that with the CEO at some point. Let's also talk about Old Mutual. They've come up with a trading update, rather thin at this point as a trading statement, but I guess pointing to issues of hyperinflation in Zimbabwe, I think worth flagging, I guess, at this point, and also expecting some sort of an increase in returns to shareholders.
Yeah, so as you said earlier in the show, they're expecting HEPS or headline earnings per share to be up between 16 to 36%, so up about 26% at the midpoint. And they flagged a few drivers of that pleasing earnings growth. One is growth from the core business, but then secondly, they're also benefiting from stronger markets. I mean, obviously, as an insurer, that's quite an important additional tailwind for the business. So I think quite a decent trading update from Old Mutual.
Then let's talk about Attack. They also seem to have done super well, that GEPF deal going through. And I think that's really what they're choosing to highlight at this point, how good that has been for the strength of the balance sheet.
Yes, in the update, they do one of the first points that they highlight is the reduction in leverage that they've been able to achieve as a result of that. If you look at, for example, Attack's update today versus, let's say, Hyprop today said that they're actually not going to be paying a dividend, given the pressure that their distributable income is under. And obviously, as over the past few years, leverage has been a challenge within the property sector. So I think Attack's announcement today contrasts quite sharply with, for example, Hyprop. In Hyprop's case, they're saying, as you said earlier in the show, that their distributable income will be down by about 13% on a per share basis. And I thought what was also interesting is they highlighted the impacts that Pick n Pay's recent announcements have had on them, on Hyprop, given the fact that Hyprop has Pick n Pay as one of its largest tenants.
Well, with that said, Seleho, I'd like us to go into stock picks, but first I'd like us to reflect on counters that have found favor with your industry peers.
I'm going to go with Aspen. Last time I was on with Mark, I went with GSK, he went with Aspen. I think the results were good. Stephen and company looked as though they really had their arms around this business. I think there's a lot of optionality. I think the South African contribution is modest at probably about 20%. They've built a really good portfolio of businesses, and they're almost becoming a platform. So when I look at this business, I think it can, after a difficult year last year, I can easily see this business delivering 10, 12, 14% earnings growth for the next couple of years or next few years. And then suddenly that 17 PE doesn't feel that far. So I think Aspen's really positioned themselves very, very nicely. And if I may say, I think the elections will definitely introduce a coalition government. What we've got to pray for is that you don't find really odd bedmates getting into bed together, because that I think could be very destructive. But apart from that scenario, I think the South African operations, as well as the rest of the market, should actually do quite nicely.
I'm going with Sanlam. We've seen again a very strong update from them. They continue to be the best managed business, the best insurer out there. The nice thing about insurance is you get a benefit of the tailwind of the market. If the market's, we've got these low valuations, and if we see some recovery over the next few years, that will be a separate tailwind over and above a very strong core business that they have. They're making good capital allocation decisions in Africa. They've done that Alliance JV, so they're not over-investing. They're not putting too much capital at risk. I think that's a really smart move. And then, of course, you've got the little kicker, the jewel in the crown there, is the stake in Shriram in India. And we work out in the next 3 3 years or so, that will be 25 to 30% of the business and of the earnings of the business. And that's meaningful if you consider the growth rate. That economy is growing at 7% a year, which is 7 times the rate of South African. So the potential there is massive, and I think that could continue to grow. And I think it's undervalued. So that's my pick of the day. It's Sanlam.
I'm going with Alphabet, which is the parent company of Google. And if you look at it from a overall perspective, Google does dominate the search business. And from that business, they generate very good cash and earnings with regards to advertising, which comes at high margins. And then they've got some adjacent businesses with the likes of YouTube, the cloud business. Although you have big competitors like Amazon and Microsoft, the cloud business and storage space is still a very good growth vertical for them. They've got a strong balance sheet, which makes them immune to some of the macroeconomic noises that we see out there, and they can also use that to make strategic acquisitions, show up the, do some share buybacks and pay out dividends. So I think overall a very strong moat that Alphabet has, which sets them well for a difficult macro environment, but also to grow with regards to the IT world that we live in.
All right, Seleho, keen to get your thoughts on some of those counters, Aspen, Alphabet, as well as Sanlam.
Yeah, sure. Maybe to start with Alphabet, I think that is probably one of the more interesting discussions happening amongst investors right now is the view on Alphabet and particularly Google. If we think about Google over the past 10, 15 years or so, maybe 20 years, obviously it's dominated the search business. It's had 90% plus market share within search. Microsoft, for example, has spent billions of dollars on Bing to try and get a foothold in the search market to no avail. But for the first time over the past year or two, OpenAI and others, Perplexity, for example, these LLMs, large language models, have posed a threat to Google's search business. So it's really fascinating to see how that's going to play out. Alphabet itself has lagged the S&P 500 this year, so I think that tells you that investors are unsure of how to evaluate the future prospects of this business. And you have some investors who think that it could potentially be the start of a decline, and others who are pointing to its historic moat and saying they can continue to dominate that business. So a very interesting case that we have with Google at the moment, or Alphabet.
With that said, Seleho, which stock are you going with this afternoon?
Sure, yes. It's one that I think I've picked before. It is Spotify. So they are the largest music streaming company in the world. They have about half a billion monthly active users. They are competing with companies like Amazon, Google, Apple, and ordinarily that would make one a bit circumspect about investing in such a business. But I highlight that because despite competing with these large platform companies, they've been able to thrive and actually lead the market, which I think is a plus in their books. They were profitable in their fourth quarter of 2023, and it looks like that's a trend that will continue. They've been growing revenues at a roughly 18 to 20% clip, and I think they should be able to do that going forward. And it's really a network effects type of business, in the sense of the more users you have on the platform, the more attractive it becomes to content producers and vice versa. So quite an interesting business in Spotify.
Brilliant. Well, it's been a pleasure speaking to you this afternoon, Seleho. Thank you so much for your time. That was Seleho Tsatsi from Anchor Capital.